The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Raymond James Financial Services, or JFS, as well as Lee Sipe and Associates. And most importantly, I'm the founder of Serving Those Who Serve. And I will begin, as I always do, by saying thank you. Thank you for taking time to listen and watch. And above all, thank you for your service. To the government, to the country, to me, to everyone. You do not hear that enough. You will always hear it here. Another thing that you always hear with us is my buddy, Ed Zerndorfer, the guru. He's back with us once again as part of our ongoing mission to reach, teach, and serve you. Once again, we're going to follow Ed's FedZone articles. That's fed-zone.com. Not everybody has time to read, so we're going to talk about them so you can listen or you can watch. And, we have a theme here at Serving Those to Serve. It's milestones, because there are so many things that happen in somebody's life financially. For our clients, we keep track of the milestones. Okay, we call it a milestone minder. But we want to make sure that our feds are educated and know what they are. So you've got a super interesting article leading up to tax time, and that is age milestones for federal employees and retirees with respect to federal income taxes. So you've got a big old table here, chock full of relevant ages. So let's go ahead and jump right in, because out of the chute, over a 17-year period, we have a bunch. So let's start off with the 13-year-olds. Tell us what we got here, Ed.
Yes, Dan, I just want to say it is tax season as we speak now, so in case
your favorite time of year, right?
You get that time of year, and many employees and retirees do their own taxes. That's fine. If they use software, a lot of the information I'll be talking about today is built into software, but there still might be some people out there who do it by hand, do their taxes by hand, and they really need to be aware of these age milestones with respect to federal income taxes. We're going to start off at the age of 13. Yep. 13. So if an individual is filing their taxes and they have children, and they have children who are under the age of 17, for every child under the age of 17, they receive a $2,000 tax credit. Oh, I love tax credits. They're a dollar for dollar reduction of one's liability. So
Yep.
The problem is that when that child turns 17, they no longer get that credit. Like, for example, I have a client. He has a daughter, and his daughter was born in 2006, July 2006, and guess what? She turned 17 last July 2023. Did his taxes. The child care tax credit is not there. Now, there is another $500 tax credit for any child, or I should say any adult that you claim as a tax dependent, but it's only $500. So when I showed him his taxes, what is this $500 tax credit? Well, your daughter turned 17 last year, lost the $2,000 tax credit.
Gotcha. So then we've got age 18's next, right?
Well, let me be careful here. I think I jumped the gun a little bit, Dan. I'm sorry.
Did you jump over 13? Yep.
I went to 17. I skipped over 13. I'm sorry about that.
Let's go back to 13.
Let's go back to 13. We're talking about not the child tax credit, but the child care tax credit. The child care tax credit. We're talking about if we have a working taxpayer and the taxpayer is married, both of the spouses are working, and they have to pay for daycare expenses. They put the child in a child care center during the day so both parents can work, or they might drop them off at nursery school, or somebody comes to the house to take care of the kids. They're entitled to what's called the child care tax credit. The child care tax credit, which is, again, it's a tax credit. You could receive as much as $600 of a tax credit up to 2 or more children. For one child, it's $600. But here's the point. This child care tax credit ends when a child turns age 13, anytime during the year 13. So we have some individual whose child turned 13 last July. And that child went to day camp. That day camp does qualify for child care expenses, day camp, not night camp, day camp. But since the child turned 13 in July, can't use it.
That was good while it lasted.
Good while it lasted.
Okay. So now we're back on track. We're up to 18-year-olds.
18,
what do we got there?
18. Okay. So at age 18, any individual who would like to make a contribution to what's called an educational savings account. And they call them Coverdale Educational Savings Account. They used to call them educational IRAs. You can put in as much as $2,000, and the money would be used for any type of education. The money could be pulled out tax-free. We're talking about the contribution, which was made with after-tax dollars, but all the accrued earnings would be pulled out tax-free to pay for any type of education. That includes nursery school, let's say parochial school, that includes junior high school, as well as college. All the money can be pulled out. It does not have to be used for post-secondary education. It can be used for any type of education. And the money and anybody can put the money in. It could be a parent, a grandparent on behalf of the child. But the limit is $2,000 per year. But when that child turns 18, nothing can be contributed to that child's educational savings account.
Gotcha.
So that's for 18. Also, an individual who is filing their tax returns, and there's something called the Savers Tax Credit. This is, again, a tax credit in which if you are contributing to some type of retirement account, let's say like an IRA, and your income is below certain because there are AGI limitations, you can get as much as a $2,000 tax credit. Now, what does 18 have to do with it? There are some very ambitious young people who go out and get summer jobs, and they earn, let's say, a couple $1,000s, and their parents say, because you have a job, earn income, you could put the money into an IRA. In order to contribute to an IRA, you have to have earned income. Well, here, you had this summer job, and now start saving for your retirement. Take a part of it, or all of it, and put it into an IRA, the money you earned. Well, that is true. That is true in terms of a child, but the child would not be eligible for the Savers tax credit if they're being claimed as a dependent on their parent tax return. When they're 18. But they still should put the money into the IRA. Into the IRA. So
gotcha.
That depends when a child is 18.
All right, now we're up to 19.
19. Okay. Parents have children, and let's say a child turns 19, they can no longer claim that child as a tax dependent unless the child is a full-time student.
Yep.
They go to college. That would continue until the child turns 24, as long as they're a full-time student.
Gotcha. And then we've got
Also,
something at 19 about the kiddie tax, right?
And then we have the so-called kiddie tax. Kiddie tax. Now, when I started this tax business, I hate to say this, like 35 years ago, the kiddie tax was instituted back in the 1986 tax law. It only applied up to age 13. Congress expanded it. Then they went to, I think, 16, and then they went to 19. Well, now it was increased to 19. If a child goes to college, it goes to age 24. So again,
oh wow,
when a child turns 19 and they don't go to college, the kiddie tax no longer applies.
Gotcha. So then our next jump is up to age 24. And this is where, even if our kids went to college, we have that tearful moment where we can't claim them anymore, right?
Can't claim them as a tax dependent.
Yep.
And also, the kiddie tax will no longer apply.
Yeah, because, I'm going to say I have some clients that have some kids who are in grad school that still consider their kids to be kind of dependent, but uncle does not see it that way, and I understand that. So now we're up to 25, which is the earned income credit. What do we got there?
I have to admit, I don't have much experience in this area, but I do follow the Internal Revenue Code, and the earned income credit, which is basically for individuals that have low income, but they're working. They're eligible for what's called the earned income tax credit, which is a refundable credit. In other words, even if you have limited or no tax liability, you're still going to get this tax credit. Individuals with no children, they qualify for an income credit. Until age 25, until an individual who has children would be able to qualify for an income credit. But if they don't have children, they're going to have to wait until they're 25 to be eligible for this earned income credit, tax credit.
Gotcha. And now we jump 2 years to 27, and this has something to do with health insurance coverage. Tell us about that.
Yeah. Again, I don't have much experience, especially dealing with federal employees when it comes to this, because at age 27, the income exclusion for health insurance coverage of children aged 26 and younger expires. When you have a child who's under the age of 26 and you're paying for their health insurance coverage, that would not be included in the child's income until they turn 26.
Gotcha.
As you know, the federal employee health insurance, when a child turns 26, unless they were disabled before age 18, they are no longer eligible to be on the federal employees or retirees health insurance plan. They have to go out and get their own health insurance. And if the parent is paying for that, then it would be included in the child's income. They have to go out.
So that's income for the kid. That's good to know. Yeah. All right. Then we jump 3 years to Coverdell Educational Savings ESA. What are we talking about? We talked
about the Coverdell Educational Savings Account. The child has this Coverdell Educational Savings Account. Money was put in it for years until the child would turn 18. By the time the child is age 30, all the money in that ESA has to be used. It has to be used. Or in case it hasn't, it will be dispersed. And the contributions that are in there are not going to be taxed, but the accrued earnings that are left in there will be taxed when the money's taken out.
Gotcha. Okay, so now we have a big jump. So we're going to jump 20 years all the way to age 50. What do we have that folks need to know here?
Oh, 50 is a big age, Dan. Okay.
Yeah.
Okay. And this has a lot of implications for federal employees. So when an employee who has access to a qualified retirement plan, like a 401k plan, a 403b plan, the TSP, when they turn 50, anytime during the year they turn 50, they're eligible to put extra money into their qualified retirement plan. It's called the catch-up contributions. I get this question all the time. I'm turning 50 this year on October 31st, 2024. Does that mean I have to wait until October 31st, 2024 to start making my catch-up contributions? No. You could have started as of January 1st, 2024. because you're turning 50 sometime during the year. And
Absolutely.
that means you can start making those catch-up contributions, the extra contributions. This year, it's an extra $7,500, and you could have started that back in January 1st.
Gotcha. And then qualified public safety employees have something here too, right?
Yeah. If you are a qualified public safety employee and under the federal, that would include, we're talking about law enforcement officers. We're talking about, these are federal law enforcement officers. We're talking about federal firefighters. We're talking about customs and custom border and protection officers. We know they're busy, especially down there on the border these days. The officers, they can retire at age 50 with a minimum of 20 years of service, so they can actually retire at any age with 25 years of service, but they can make penalty-free withdrawals from their TSP, from their traditional TSP, starting at age 50. But once again, under the Secure Act, let me just go back. Actually, if they retire at any age with 25 years of service, this is a public safety employee, they can start making penalty-free withdrawals from their qualified retirement plan. Just use age 50 because if they retire at age 50 with 20 years of service, and they also can make penalty-free withdrawals from their TSP or 401k plans.
That's
not
big.
Not Irish.
That's big. Okay. Now we got a 5-year jumping up to 55. So what do we have there?
Yeah, I get this question a lot. Ed, I'm a federal retiree and I've had this traditional TSP account. And I'd like to know when I can make withdrawals from my traditional TSP and not be subject to a 10% early withdrawal penalty. And the answer is, if you retire sometime during or after the year you turn 55, you can make penalty-free withdrawals, no 10% early withdrawal penalty from your traditional TSP, not Roth TSP, personal TSP. Now, if you work in private industry, the same thing is true. You can make penalty-free withdrawals from your traditional 401k plan, 403b plan, but then there's a difference. And I wrote a column on this years ago. The difference in private industry is, in order to make those penalty-free withdrawals, you have to be 55 or older on the day that you retire. With the TSP, as long as you turn 55 sometime during the year that you're going to retire, you can make penalty-free withdrawals from your traditional TSP. So, for example, if an employee retires, let's say this coming October 31st, 2024, and they are going to be turning 55 years old, let's say they're going to turn 55 years old on November 30th, 2024, then they can make penalty withdrawals right when they retire. They don't have to wait till their 55th birthday. That's a big difference. Gotcha. I got a lot of questions about that between the TSP and 401k plans, 403b plans.
Gotcha.
Also, 55, another one. HSA contributions. Those federal employees who have health savings accounts, HSAs. The year that they turn 55, they can make an extra $1,000 contribution to their HSA, $1,000. It's like the catch-up contribution for HSA owners. HSAs have annual contribution limits. The limits that you see is you add $1,000 to that limit if you're 55 or older that year, and every year thereafter.
Gotcha. Now we jump almost 5 years here to an age that I think most of our feds are going to recognize. There's a lot of rules that have been publicized on this, and that's 59 and a half. So we got some good news here.
The good news is that if you are 59 and a half or older, you can make penalty-free withdrawals from your qualified retirement plan. You can make penalty-free withdrawals from your TSP. In particular, if you're a federal employee and you're still working at 59.5, many employees are not aware of this. You can make what's called in-service withdrawals from your traditional TSP and not be subject to a 10% early withdrawal penalty. In-service withdrawals. I generally discourage that because you shouldn't be taking money out of your retirement plan if you're still working. But some people have to. Whatever reason they have to, they can. They're not going to have to pay federal and state tax, but no 10% early withdrawal penalty. Also, I think I didn't list this. When you turn 59.5, you can make penalty-free withdrawals from your traditional IRA. IRA. Now, there's sort of something I want to mention about this, about in terms of the Roth. I keep emphasizing the word traditionals here. Traditional TSP, traditional IRAs. Roth IRAs are in a different category.
Sure.
Little different category. And then also Roth TSP. When it comes to the Roth, if you want to take money out of your Roth IRA, first of all, you can always take out the contributions, no problem. Penalty free at any age. You can request just the contributions to come out. Why? Because the contributions you made to your Roth IRA were made with after-tax dollars.
Yep.
But if you want to take out the earnings from your Roth IRA and not be subject to having the earnings subject to tax,
yep,
as well as a 10% early withdrawal penalty, number one, you have to be at least age 59.5, and this is important, it has to be at least 5 years since the January 1st of the year that you made your first Roth IRA contribution. That's that 5-year rule that many people are not aware of. Keep in mind that Roth IRAs have been around since 1998. That was 26 years ago. Go back to the year you made your very first Roth IRA contribution. It could have been 2002, sure. Anytime during 2002. So your 5-year meter starts as of January 1st, 2002. So 59.5. Gotcha. Roth TSP also has a similar rule. In order to take money out of your Roth TSP, you have to be 59.5 or older, and you can do that. You can make what's called in-service withdrawals, but also it has to be at least 5 years since January the 1st that you made your very first. It only goes back to that very first Roth TSP contribution. Roth TSP has been around since 2013. If you made your first Roth TSP contribution in December 2017, your 5-year contribution meter started as of January 1st, 2017. It always goes back to January 1st of the year you made your first Roth contribution. So you could take money out of it. I'm not encouraging that. You should try to leave that Roth in there as long as possible. Let it grow tax-free.
Gotcha.
That's 59.5.
Then we jump to 65, and we got 3 happening.
3 big ones.
With this year, right. So talk about it.
All right. So first one is those individuals who, when they file their federal income taxes, take the standard deduction rather than itemizing, and most people now do it. Most people do now take the standard deduction. Why? Because when Congress passed the tax law in 2017, they decided to double the standard deduction, and they limited also the number of itemized deductions. So more people now are actually taking the standard deduction. When you turn 65, you get an extra standard deduction. For example, I'm over 65, so is my wife. So we get an extra $1,800, $900 for myself and $900 for her. Also, if you're blind, you get that's another extra standard deduction if you're blind. But for people who are 65 or older, they get that extra standard deduction out for the standard deduction. Second one is, this is interesting, if you are a health savings account, you have an HSA, a health savings account, normally you take money out of there, tax-free to reimburse you or to pay for medical, dental, and vision expenses, or other items like long-term care insurance premiums, or if you're on Medicare to reimburse you for Medicare Part B and Medicare Part D premiums. But when you turn 65, you actually can take money out of there to pay for anything. You have to pay tax, though, on that.
Gotcha.
But no 20%, I repeat, 20% penalty. If you're under 65, you take money out of your HSA to pay for anything but medical, dental, vision expenses, you have to pay tax and a 20% penalty.
Ouch.
Penalty.
Ouch.
Okay. But when you turn 65, that 20% penalty goes away.
Gotcha.
And then finally, I have to admit, I haven't had much experience doing, professional experience taking this one. When you turn 65, you're eligible for what's called the elderly tax credit. It's called the elderly and disabled tax credit. It's based on your income. If your adjusted gross income is too high, you're going to not be eligible for that tax credit. But it's only for people 65 and older. It's called the elderly tax credit.
Gotcha. Then we slide forward to another age that has gotten a lot of publicity, and over the years, that's 70 and a half. So we got two things happening here.
Well, Dan, I know you've been in this business a long time.
Yes, I have.
70 and a half used to be the magic age for our good friends, the required minimum distributions. If you have a qualified retirement plan, like a 401k plan, a 403b plan, the TSP, and you are retired, every year starting when you're 70 and a half, you have to take out what's called the minimum from your account, the required minimum distribution, every year for the rest of your life. Start at 70 and a half. Well, that was the rule until the passage of the Secure Act 1.0, which was passed in December 2019. 70 and a half. You had to take your first RMD no later than April 1st following the year you turned 70 and a half. With the passage of Secure Act 1.0, the RMD age increased. And the next age, we'll talk about next age. That turned out to be age 72. We'll talk about that. But if you were born before July 1st, if you were born before July 1st, 1949, your RMD age continues to be 70 and a half. So now obviously we passed that now. So you know that you passed that RMD age. So that's what 70 and a half. So that's one thing 70 and a half is known for. And the second thing is something called qualified charitable distributions, QCDs. What are they? These are, you can take money out of your traditional IRA and make charitable contributions, and the money that is withdrawn from your QCD, from your traditional IRA, will not be included in your income. And the IRA custodian makes out the check to your favorite charity. It decreases the size of your traditional IRA. You get no charitable contribution deduction. So what is the purpose of the QCD? Well, one purpose of the QCD is by starting to take the money out of your traditional IRA, no earlier than age 70 and a half, it's going to decrease the size of your IRA, which means that when you do turn, when you you reach your required beginning date, which is what we just said was 70 and a half for people born before July 1st, 1999. It's risen to 73. The balance in your traditional IRA will be decreased, thereby decreasing the amount of your RMD, thereby decreasing the amount of taxes you have to pay every year that you have to take the money out.
Yep.
Let me say this, that you still can make a QCD even if you've reached your required beginning date. Like this year, 73. I just reached my required beginning date. I turned 73 a couple months ago, and I'm still making my QCDs and I will take my first RMD sometime later this year. The fact of the matter is that and this is a word of caution. I think I wrote a Fed Zone column about that. Be careful with QCDs, the timing of those. That you need to do your QCD in the year, if you have to take an RMD, before you take your RMD. Just keep that.
Makes sense. Makes sense. And so our final 2 years, we can kind of tackle them together because they were both impacted by Secure 1 and Secure 2. And that's RMDs have changed. So 72 and 73 now matter. Tell us about those.
Okay. So Secure Act 2.0 passed the law in December 2022. One of the changes, there are a whole bunch of them in there, as a result of passing Secure Act 2.0. And one provision of Secure Act 2.0, it raised the required beginning date for individuals born between July 1st, 1949 and December 31st, 1950. If you were born between those two dates, your required beginning date, that is the year you have to take your first RMD, is April 1st, following the year you turn 72. Okay? Then, if you were born between January 1st, 1951 and December 31st, 1949, your required beginning date is April 1st, following the year that you turn 73. There's one other date which is not listed in the table. I figure we got time to put that in. If you were born anytime after December 31st, 1959, your required beginning date is April 1st, following the year you turn 75. So 75 will be added, maybe within a couple of years. I'll add it to the table.
Gotcha.
But for now, that's enough.
Gotcha. Woo, buddy. That is one big list, Ed. And once again, these milestones are so important. We track them for our clients, but we're putting them out here into the world to help all of our feds. And as usual, Ed, you are the only guy putting this stuff out. So another killer article. Thank you, sir. On behalf of the feds, thank you for being such a great resource and also for being a great resource for us here at Serving Those Who Serve. Folks, that's a wrap. We are Serving Those Who Serve. So hit that subscribe button. If you're watching this on YouTube, also, if you're listening on Spotify, remember to share it with your friends and strangers. Don't forget our live webinars every single week. Just go to swserve.com. You'll see the blue button. Click it. It turns red. Takes you to the full page. Tons in there. The guru will come to you. Reach you where you are. Teach you where you are. And above all, serve you where you are. Sign up for one. Sign up for all. Share it with friends and strangers and enemies. They will all thank you. Be sure to read Ed every single week in the Fed Zone. And for this particular one, if you're listening along, grab that Fed Zone article so you have the table in front of you. His stuff is always fantastic. You can find that at fed-zone.com. So signing off for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I will say goodbye as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you absolutely positively deserve it. Stay well, everybody. We are out.